I titled this presentation, here, let's flip to it. Will 2013 be any different? And I know, it's right after lunch, you guys are tired, and you've already survived through 2012, and you're probably looking for 2013 to be a little bit different, a little bit more optimistic probably. Well, I wish I could present a very, very, bullish story, either if you're a producer or consumer. I know both of you have different perspectives, but there hasn't been a significant amount of developments in the market, and what I'm going to do throughout this presentation, I'm going to talk about what some of those changes that need to occur to see a change in supply, see a change in demand, and then also to see a change in price, depending what direction you want it to go in. So we'll start here as a disclaimer. We try our best. Sometimes we're not right. I'll show you our forecast for a year ago and talk about what we got wrong and where we're going now. So we do try our best. This is a little scheme of CPM Group. We're a commodities research groups, but we have a range of services. I'm in research. I also do consulting. We have a financial advisory arm and also a asset management program we're building out now. We have been around for a long time. We've been around since 1986, and we really strive by having the research as the center, the focus point of our network, and have many of our contacts either be from consumers, producers, investors, governmental bodies, all come from the research component of our business. So where does molybdenum stack up? So this chart right here, you can see, it's hard in the back room, but it's index molybdenum prices with other LME traded base metals, and it's molybdenum's navy line, and you can see that it's trending along with many other metals, and those are ferroalloys. We've seen kind of a rise until 2011, and then since 2011 we've been trending downward. One thing molybdenum is not, it's not copper, which is this green line at the top. And because it's not copper, that has influenced its supply dynamics, which I'll get into in a little bit. Molybdenum is also not cobalt, which is trailing at the bottom, and I'll let my colleague go into that a little bit later on. Then we'll look at how molybdenum stacks up comparably to some of the other metals that are deemed critical, or metals these are select metals that have faced either export restrictions or mining quotas from China. And molybdenum's, again, easy to identify because it's trailing at the bottom right here. And I'll talk to you about why molybdenum is here and not with these other metals throughout this presentation. But I just wanted to put that in front of you right now so you can see how molybdenum is comparing to some of the other metals we've talked about today. So, because it's after lunch and you guys might be sleepy, I decided to put some of the conclusion. The price outlook for the next couple of years is at the end, but some of the conclusions right in the beginning. How does molybdenum compare to 2012? And I also threw in here our outlook a year ago for demand and supply. So this blue line is this is 2012 actual real performance. We have it for supply, for demand, and for prices. The red line is our forecast from a year ago, and then the orange line is our current forecast. And so 2012 for supply was pretty dreary. We had negative supply growth of about 5%. Most of that came from byproduct operations, which encountered lower grades and had many operational difficulties. Major problems in Chile, flat growth in China. I'll get to some of the other regions later. 2013 was looking to be a much brighter year in terms of supply, and most of that had to do with gradual expansions. It was all moderate increases. Also stronger growth in China because we thought that we had a little bit of firmer prices. If you look at our price outlook, we had $14 moly last year. We've revised that lower, and that would have contributed to more supply growth. with the lower price outlook, we have less supply growth, and so we still have positive growth, but it's a little over 4% for 2013. In that same token, we've shaved off of demand. We've had really moderate demand growth, about 2% in all of 2012 for moly. And we brought down our demand forecast for 2013 based off our economic assumptions and our view on the global steel markets. And how this plays out in supply, well, because we've shaved off both supply and demand, we aren't dramatically influencing the supply-demand balance, but we have had to shave down our price outlook, and probably more than you would expect given the change in the supply-demand balance. And part of that is, what I'll show you on this, actually in the 2 slides, is what our outlook is in China and how soon the US and European markets are going to converge with what we're already seeing burgeoning kind of in China right now. So throughout this presentation, we're going to talk about, what has changed, what's caused some of these changes in our outlook, and then what needs to change for prices to respond, for demand to grow, and then also to supply to either move higher or lower. We'll start by looking at some of the current topics in the market, which always include looking at the supply pattern in China. We'll talk about the byproduct market and how that's influencing supply and what the outlook for some of these byproduct streams are going forward. We'll switch over to fabrication demand, and then I'll give you a 3-year outlook on prices. But let's dive right into supply. So this is just kind of a refresher slide for some of those who are not as familiar with the industry, but for the most part, the biggest consumer is China. That's 36%. China is largely a primary producer of molybdenum. Many of these other supplies, particularly from Latin America, are byproduct supplies from copper operations. From North America, the US and Canada, it can be a bit more mixed. But we do have the most significant kind of influence in pricing and supply has been in China. And the reason why it's influenced pricing is because China is a marginal cost producer, and they kind of set the prices for the global marketplace. And here you can see this is the supply growth of these different producers over time to get a look of where supply has been. And you can see really tremendous 50% year-on-year growth up until 2008 in China, and it overtook US as the largest producer at that time period. Then we had a really dramatic pullback in supply in 2009, and that was correlated to prices. And then we've had this kind of relatively strong recovery in 2010, 11, and it's flatlining off. And there have been a series of policies that have come out in China, actually since 2006, even earlier than that, but that hasn't been the biggest influence on pricing. Pricing has been the biggest influence on supply rather than the policies in China. They have gradually unfolded policies over the years, but really what's setting the growth in Chinese supply and in the actual growth in global supply, given these growth rates in earlier years, has been the price of molybdenum. And because prices have tapered off and they've declined through 2011 and remained low and declining through most of 2012, we saw a practically year-on-year flat growth in China for 2012. And we do think that there's very limited likelihood of prices really supporting that much strength in the next couple of years. So I guess some of you might be wondering what caused the decline in Chinese supply given the flat supply growth in 2012, given that prices were just about 13% higher than they were in 2009 when we saw that big dip in supply. So why were they not as price sensitive last year comparably to where they were in 2009? And the reason for that has to do with the cost of production in China. And the reason why I pulled up this chart, because I find it a very good chart to kind of reveal different floor prices for Chinese costs over the past couple of years. Costs are all relative. So when prices were in the $30, $25 range, we had, $15, $17 marginal costs in China, outrageously high. Obviously, those operations aren't around anymore. And we had a new kind of price floor set since the recession. In 2011, we had a marginal cost range in China of somewhere around the $10 to $13 range for total cost. And that kept prices fairly elevated. But when we're coming into 2012, we had a decline in costs in China. We saw costs come off, to the $8 to $11 range, which lowered the floor price in China, and in fact lowered prices in the rest of the world, because the Chinese producers were actively working to lower their cost of production by either cutting their stripping or high grading, and therefore they could continue to operate in this low price, weaker demand environment. But those two developments, they're not really sustainable developments. You can't cut stripping forever, and you can't high grade forever. And so we've had this uptick in Chinese prices in late 2012 and in 2013 as their costs have started to rise. And the reason why prices have risen is because Chinese producers are very rational. They don't sell below their cost of production, and so they weren't selling. Tight supplies got a little tighter, and the prices in China rose. But they didn't rise all over the place, and they didn't rise in the U.S. And so we saw a narrowing of the arbitrage between China and the U.S. And this is really unique. This is something that we thought when I was looking at the market a year ago. I knew costs were going to go up in China. I knew that this activity that was occurring was not sustainable, and that we would see higher prices back to probably 2011 levels in 2013. But the markets didn't converge at the same rate as I thought they would, and we now have this dichotomy between the two. And that has actually created this window for even arbitrage, and even for China to be a net importer in the next couple of months if it continues to occur. You can see this is the differential between the two markets. And these prices for China are ore, so we adjust them for the roasting and also for the VAT and some differentials in grades. But you can see the spreads between them, and the only other time that we've had a spread where we had China being this is a positive arb into China, was in 2008 and 9 when we had China being a net importer. Now, I don't expect China to be a net importer. There's no need for China to be a net importer. They have stocks. I'll show you down in the next couple of slides. But there is also this new opportunity, because it's just pointing out the fact that the two markets have diverged, and now it's just a matter of time before the US and the European market catch up with the trend that's occurring in China. One thing that we have influencing the trade dynamic right now particularly is the current standing on the WTO case, which is positioned against China by the US, European Union, and Japan, by certain consumers who brought it to the World Trade this summer, actually last spring, and continued working on it this summer, to say that Chinese export policies violated WTO rules. While this case is still pending, there are certain implications which could occur if China were to reduce cut their duties. Their quotas aren't really affecting supply right now. particularly on the exports. So because we have this WTO case pending, there's been kind of a delay in new policies coming out of China. You know, we haven't really seen that series of mining quotas and export quotas and taxes that had come in previous years. In fact, in 2012, they got rid of their mining quota on molybdenum. This is something that had been in place for the previous 3 years, and they unwound it partly because they were facing these allegations, and they decided that they needed a different system. And I'll talk about their different system in the next slide, but what's down the road is we have had the molybdenum policies in China not really have a significant influence on pricing, as we saw in the first slide where I showed molybdenum prices in actually I showed prices of index critical metals, and you saw molybdenum at the bottom. And one reason for that is because molybdenum right now is currently under control of the Ministry of Industry and Information Technology, which is an organizational group in China that has set most of the set all the policies in China on the molybdenum industry over the past couple of years, and it's been effective in setting some type of standards and encouraging consolidations, but it hasn't had the same influence on the market by being a strict enforcer, tougher regulator than some of the other governmental bodies in China. And in particular, the Ministry of Land and Resources is one where they're able to more strictly impose their policies. And right now, there's certain policies that have been proposed by the Ministry of Land and Ministry of Land and Resources, the MLR, that could dramatically influence supply going forward. This is a reclassifying molybdenum as a national resource versus where it is right now, which is considered a restricted metal where it faces some limitations on expansions and new development. But if it's reclassified and switches from this one organization to the MLR, then we'll see much tighter policies down the road, which could really influence supply. So with that, molybdenum would be potentially reclassified as a strategic metal, which could be more positive for prices. And we could see a cut in the export tariffs and quotas down the road with the WTO ruling, which would most likely be replaced by some type of continued resource tax. Last year in February, we had a new resource tax imposed on molybdenum based on the ore grades. And taxes like that are more likely down the road, especially once they remove any type of export quotas that are in place. They've already removed the mining quota. So with removing the mining quota, they replaced it with these new industry standards, and these came out last year. They are entry standards for the molybdenum industry, and they set requirements for new expansions and also for new projects and also existing current operating projects. And so they set minimum capacities, and they also, with that, impose certain technological, environmental, and safety standards, all to create, increase, product quality and whatnot. But the kind of important things about these standards, they're gradually being imposed right now. First, pretty much through 2012, it's been an information session where the provincial governments have been reaching out to the different projects, learning more about the projects, seeing how they fit into these new standards. And then down the road, these standards will start to get imposed, and that could have a significant influence on supply, because right now only 10 of the operating mines even fit into the capacity standards that have been imposed in 2012. And in terms of smelters, very few of them also even fit into these particular standards. So there are changes occurring. They're happening gradually, and I think kind of the biggest catalyst for new change going forward would be first finding out what the WTO ruling is, then seeing if molybdenum gets reclassified as a strategic metal or one where it's a national resource where it's being monitored by the MLR, and then see if these new policies actually get imposed. But without that, we continue to have molybdenum supply in China governed by prices. And if there's higher prices, that means there's going to be more supply. And this slide right here, this shows, this kind of gives you an idea of where stocks are in China and where they are in the rest of the world. So this is implied market balance between China and the rest of the world. You can see that we've had a really dramatic surplus build up in China in 2008 when they became a net importer. And since the surplus has remained there, much more moderate, but because of this surge in 2009, we have almost 200 million pounds of molybdenum that are currently estimated to be held in China. That's about 11 months of demand. And the rest of the world, if you sum up, over these years, we're actually at 85 million deficit. So, there is metal that potentially could have come from China to go supplement the other world, and either through smuggling or other means where consumers didn't want to pay the export tax. That's a 20% export tax out of China. But we still have a fairly significant stock build in China, which is one reason why we do not think there will be a net importer anytime soon, but the trade would allow for that. So I've been talking all this time on China, and that's interesting because it's 70% of the primary market. Primary market makes up about 50% of the total supply. But the other big contributor is byproduct producers. And you can see here, this is the contributions of byproduct producers to supply for the past since 1985. And in the last decade, the average for contribution was about 56%. We've dropped down to have it be more even, but things are changing. And as more supply comes on from byproduct producers, not only are we shooting up to, in this chart, you see it going, which is through 2014, up to about 56%. It's going to rise to over 60% in the coming years as some of the bigger projects come on and more byproduct supplies come on. So byproduct producers are going to have a greater influence in contributing to supplies, and that can be have a whole different effect on pricing. And in 2009, when we had that pretty dramatic dip in pricing, we had actually increase in byproduct supplies while primary producers slashed their output that year. And byproduct supplies can be fairly unpredictable. Some of it has to do with the fact that the copper companies are focusing on their copper grades, and they're not concerned about their molybdenum grades to the same extent. And so when they encounter certain years of lower molybdenum grades in the head grade, that's just so be it. Then the supply falls. And we had a pretty dramatic year this year with an 8% decline in byproduct operations, supplies from byproduct operations, and that was due to operational problems and as well as declining ore grades for the year. And that volatility can really influence the market because byproduct producers haven't been as price sensitive as primary producers have been in the past. And going forward, this year we had a lot of new, fresh primary capacity come online. This chart here shows new capacity that's tagged for each of the years of commencement. So even though like for 2015, we have projects coming on at the end of 2015. You see the whole capacity for that year, even though you'll see the project ramp up slowly. But we had two big projects start. We had Climax and Endaco's mill expansion, increased capacity of primary producers. The Endaco project has faced its own series of problems with lower ore grades than expected, issues with their tailings ponds. And so we haven't seen we actually saw a decline in output from this operation through 2012, but there was an increase in capacity. Much more so was the increase in Freeport's Climax projects, where they brought on this new primary operation, which has the capacity to produce 30 million pounds of molybdenum a year. They're going to initially keep it at 20 million pounds, but once the market can use and demands more molybdenum, they'll continue to bring it on stream. But as you can see, for the next couple of years, we have a series of pretty significant expansions occurring on the byproduct side. And it's, for the most part, in the next 2 years, it's filtered between a handful of different projects, so it's not all dependent on one. The timeline is a little bit, can be uncertain because it's just one project versus, another, all small capacities. In 2015, I know that you heard from our previous presentation that there will be, a lot of new capacity coming on from a byproduct operation, which is Sierra Gorda, which is really kind of all your eggs in one basket in 1 year. So there is a dramatic increase in supply coming on in 2015. And here you can see this is the life of mine of the operation. It's not the whole capacity for just 2015, which will be even greater. We also have Mount Hope, which is General Moly's project, which has received the record of decision and is now working right now to get the financing for that project, which has pretty significant initial capital costs, but they've also already kind of drafted different terms with the different China development banks. The main, I think, point in the slide is all these projects are marked in a solid color versus the transition, this one that's you can see through, is because they're projects that we consider to be committed and ones that are probable and likely to come onto the market. So there is a steady new stream of supply coming gradually onto the market, and we will continue to see byproduct producers lead the way in growth, particularly over the next 2 to 3 years. So I'm going to touch on demand. I know I'm running a little low on time. We have our outlook for 2013 to be moderately better than 2012, which kind of fell a little bit below our expectations. If you look at the leading, different leading indicators in the market, none of them are screaming at you. They're all showing some sign of gradual improvement in the market. Nothing's really, that noteworthy, but there is a sense that things are getting better, but gradually. Here you can see this is the global industrial steel production and also global industrial production and the relationship between the two. And they're trend in line together, and we've had steel production fall way below that upward trend that we've seen in industrial production, although it's slowed. But we are seeing an improvement in steel, just not a sharp increase. It's going to be a gradual uptick as we try to pull back from this cycle that we're in right now. In terms of demand, most of the demand for molybdenum is in steel. It's about 70% of the market. The areas outside of steel and the non-metallurgical and metallurgical have been, somewhat outperformers, but it's still, the market is still very dependent on major developed countries to set the pace of demand. Japan, you can see, is the largest consumer per capita, and 50% of demand comes from your developed countries. So while China has been the main contributor to growth, we're still looking at that weakness that we had in Japan and in Europe in 2012 and the sluggishness that we're expecting for this year, setting the pace for demand going forward in 2013. This is also just kind of another market that shows global steel output. And because molybdenum is so leveraged to global steel production, this just kind of highlights where the Europe and Japan war and how it weighed on the very moderate, albeit growth, in the rest of the world. Talking briefly on Chinese demand, we've outgrown an era in China where we used to have molybdenum demand, steel capacity, steel production grow at multi-level, a multiple comparably to GDP. So, we're not going to see the same 20%. This is a 20% year-on-year growth in molybdenum demand between 2001 and 2011. That's not going to occur anymore. We're having molybdenum demand fall more closely in line to GDP, if not below it. We have in 2012 very moderate growth, and this year in 2013 we're looking to be a little bit closer, a little under GDP. It's a different era, and our forecast for the next 10 years do not show that rapid build-out in capacity that led to the double-digit growth in molybdenum demand steel production. It's much more in line with the current trend in actual demand growth, which will bring it more closely in line with GDP. One thing you can see here in this chart is that this is fixed asset investments in the orange, stainless steel output in the blue, and molybdenum demand in the red. And we have stronger demand for molybdenum than in stainless steel or in some of the other steels. It's because of the other end uses, and particularly for catalysts, we have stronger demand there. There's new tighter smog restrictions that require ultra-low sulfur diesel, and those are going to be imposed by 2014, which are increasing the demand also for moly there. There's been a slow, gradual shift where we've seen more and more molybdenum used in catalysts in China comparably to tungstens, which used to be the primary market there. So there's that substitution as the markets are more capable of doing substitutions. And another thing I wanted to kind of highlight is on the demand side is what we haven't seen, which we had seen in the past, is that molybdenum is not really trailing the energy markets like it has been. We used to have a pretty tight correlation, or fairly tight correlation, between moly and oil, and that had to do with the trends that you saw in the energy infrastructure. There's demand for power plants, oil and gas pipelines, LNG terminals, exploration equipment, production equipment, nuclear equipment. All these have contributed to molybdenum demand, and we've seen the kind of nearsightedness of investors and of different companies in 2012 related to the global economic uncertainty, related to the fiscal cliff, related to just the sluggish demand that they were currently seeing affecting their investment decision and their planning for 2012 and 2013. And so until we see a renewed interest in bringing on these new projects, and some of these projects are delayed by either financing hurdles, some of it is political kind of impasses, and the fact that demand has been so sluggish. But once we start to have these new projects for energy infrastructure slowly pick up from, we had strong investment in at least in the oil sector up until 2012, it started to tail off, and I think that we'll gradually see a continued rebound in new investment in that sector going forward, but that's not priced into our outlook for 2013. So where do we see the market? We have prices falling year on year this year comparably, but it's not the same trend that we saw in 2012. We saw in 2012 it was a decline, and this is kind of a reciprocal of that. It's a gradual incline. And I think by the end of the year, we could be trading in the $13, $14 range, but that's after gradually getting to that through the year. And so for the year, we average about $12.65. But I think it's just a matter of time before we see the markets in the U.S. and Europe kind of converge with China, which is the marginal cost market, which has a higher cost of production, which is elevating the global market and keeping it in this kind of balanced condition that we're seeing right here. This is all, this surplus is, it's sensitive to, operational challenges at byproduct projects. It's sensitive to operational challenges, even at primary projects that we saw at Endako and at Thompson Creek this year. So it's a moderate balance, but it's not necessarily supporting significantly higher prices. As you can see here on the stock levels, we have really kind of flat stock levels, not going in either direction, which isn't providing that kind of catalyst for pricing. I end with a slide with the LME, just so for you guys to, if you haven't been following it, where it's at. It's not the driver of the market. We have right now contracts of open interest. It's less than 20%, but nor is it really supposed to be. The only thing that's kind of interesting about the LME traded base metals that are more actively traded versus molybdenum, which isn't, is the fact that market participants get the chance to price in expectations about where they think the market's going. And for the molybdenum market, we actually just work on where the fundamentals are right now. Where's demand right now? Where's supply right now? We don't have the same opportunity to be bullish about where things are going in 6 months. So, the fact that we've had, very little activity on the LME doesn't really influence prices, but we don't get that same luxury of having, more positive or forward-looking, it doesn't always have to be positive, forward-looking expectations factored into pricing. So I'm going to wrap this up. This is just a little summary of the different products that CPM Groups puts out. We have a molybdenum market outlook, a very thorough report that's over 400 pages long, which is where some of my research has come from. I've also just recently updated that in the past month. And I want to open up to any questions right now.
That's great. Thank you, Catherine. Do we have any questions?
Regarding the size of the market, Catherine, just wondered if you could put into £1 million and how the supply, either surplus or deficit, you forecast for 2013 compares to what you had in 2012.
Well, what we had in, let me bring that slide back actually so you can see it. We thought we were almost going to be in a deficit in 2012, but as I was pulling in the rest of the numbers, it looks like we were in a very modest surplus. As you can see on the left-hand axis, this is £1 million. So that's about £2.5 million, which in the scheme of things is nothing. It's nothing. The market supply is 520 million pounds. This is nothing, and so is this 5 million surplus for the next year. These are really moderate surpluses, and none of them have that much of an influence on, it's not an oversupply, glutted market because of that. The supplies in China, I also don't think are dramatically weighing on pricing either, because I think a lot of those supplies are kind of currently held by either they're locked up in some fashion, or they're held by people who have kind of a strategic view on the metal and where the Chinese government is taking supply down the road. But it's not a significant build, at least on the global market. Remember, there was a surplus in China, but a deficit in the rest of the world. And so this is where you kind of see the two of them merging together. Most of this increase in pricing is related to increase in cost of production in China. If we have a reduction in the export quota, export duties or quotas out of China, it's most likely, in my opinion, going to be followed by increased resource tax, because there's going to be other measures to control pricing and control production. And through that is going to be by controlling pricing, and then being able to have a increased total cost will prevent excess supply from some of the more marginal cost producers. So we do have an uptick, even though we have a slow increase in the balance, but that's really related to cost. And then a slight decline in 2015, and that is related to kind of the gradual buildup in supplies that we see coming on from byproduct producers and other primary producers, particularly in 2016 as they start to ramp up their operations.
And people I've spoken to this year so far, they've put the market at about 540 to 560 million pounds. Is that where you are with a figure, something like that?
Yeah, we have. I can quote you right afterwards the exact numbers, but I think for 2012 we were around 520, but I have to double check. Mm-hmm.
Hi, Catherine. Sarah from Wogan. Just looking at these figures, are you factoring in Sierra Gorda coming on? Because obviously, with £50 million extra coming into the market, you're only showing an increase in the surplus for 2014 of £2.5 million and for 2015 of less than one, it looks like.
We have Sierra Gorda coming on, but we don't have all the supply coming on in 2015. It's gradually building up in 2015. I know that they're scheduled to come on in late 2014, and we have them ramping up their operations in 2015 and 16. So more of the supply surplus is going to be in 2016. There are actually we're calculating in our model that another project of primary operations is going to be coming offline in 2015. We have the Thompson Creek mine that we think that will be coming off. So some of that is being offset with, the company has not announced that, but they've ended their stripping program, which for their current phase 7, and they would need to resume it. And under our price forecast, we don't think they'll be resuming that stripping program going into phase 8. So that will take off some of the supply in the market, and so that's why you're not seeing such a dramatic rise in 15, partly also.
Yeah, hi. Just looking at some of the other commodities in relation to China, aluminium, lead, zinc, nickel, it is not being particularly price sensitive. Is there any particular reason you think that moly should be any different?
Well, molybdenum is classified differently than those other metals those broader metals, aluminum and zinc and lead. Molybdenum right now is on a list with actually a handful of them. They're considered restrictive metals, where they're facing some restrictive policies in terms of expansions, and it's where we think it will be different was if it gets moved over to a list where it's considered strategic or classified more closely in line with rare earths and tungsten and some of those other metals like antimony. So right now it's falling in line with the aluminum zinc markets because those are all restrictive, but our outlook is that it will probably fall more in line with the strategic metals such as rare earths and tungsten. And part of that is because these policies have already been drafted. The Ministry of Land and Resources drafted with the new 5-year plan a new policy for the metals industry in general, but it hasn't been published. And the reasons for it not being published are hard to say. It could be some international pressures. It could be the fact that they had, political changeover, regime changeover. But the policies are pending, and we still think that they'll occur in the current 5-year plan. And so that will put molybdenum more in line with some of these other metals that have been more sensitive to pricing.
Okay, thank you very much, Catherine.